Is Denver real estate in for a housing market crash in 2021? Well, based on the comments I get on this channel, a lot of people think so. There's some that even hope so. They really want a great deal. But is it gonna happen? Let's talk about it. Hey everybody, it's Alyson Wahl with Live South Denver, your real estate strategist and realtor in the Denver area. All right, the financial crisis of 2008 to 2012 is seared in the hearts and minds of pretty much anyone over about the age of 22 to 25. They were young, but they saw their parents dealing with the crisis. So it is fresh in the minds of nearly everyone who is of the age to buy a home as they watch home prices skyrocket and think, gosh, this can't last forever and it's gonna come crashing down as fast as it's gone skyrocketing up. But is the time that we're in right now the same thing? Well, let's talk turkey, starting with the market that we're in right now. Our big picture concerns in today's market are the skyrocketing prices and the housing inventory being so tight. There are so many facets to these elements. There are numerous facets to inventory, the interest rates, jobs, consumer confidence, the what ifs of potential forthcoming foreclosures, increasing property taxes, particularly in states where property taxes are the main source of tax income, and that big what if of another COVID shutdown. All right, let's tackle inventory. Denver is seeing the tightest inventory it has seen in its history. In August, inventory was down 40% from the year before. In September, 45% down from the year before. October, same thing, 45% down from the year before. We're consistently seeing our months of inventory in our market be somewhere between 2 and under 4 weeks, 2 weeks to 3.5 weeks for the entire Denver metro area. It is slim pickings. Add to that buyer demand is up like we haven't seen in a very long time. Under contracts in August are up 35%. In September, they were up 26%, and in October, under contracts were up 28%. So with 40% plus drops in inventory, 25% plus increases in buyer demand, we have a classic recipe in Economics 101 for higher prices. When we look at the Denver metro area, which means we exclude Boulder, we see median year-over-year home price growth right now at 12%. Price growth is about the same in the condo market as it is in the single-family home market, and we are mirroring what's going on in the national market overall. Median home prices are up 15% over last year for the nation. And when you break it down region by region, we're looking at 13 to 19% increases. So while Denverites really feel like our market is off the charts and so hot, we really aren't alone. This is happening all across the country. So what is driving this dynamic and what's driving it in the Denver market? One is carpe diem and passion. I have said this before and I stand by it. COVID and this pandemic has really driven people to capitalize on their dreams now. People don't want to wait for something that is a few years out, especially when they have the opportunity right now to go out and get it. People are realizing that life is short, that things can happen that we didn't think were going to happen, and why wait? The lockdown of March and April, the intermittent remote learning for families and their students, the desired or undesired work from home scenarios that are putting pressure on families to all be in one space really has people on the hunt to have a lifestyle that they love. Sometimes that means changing their home, and sometimes that means uprooting and changing your entire life. It means moving out of the city, it means moving to a new location, it means moving to be near family. It means a lot of different things to a lot of different people. And they are no longer willing to wait and put out what they had hoped and dreamed for several years. Number two, not everyone is a dreamer. So on a more practical note, interest rates are fantastic. People are locking in rates well below 3%. We're talking 2.5%. Sometimes better if they are putting a very large chunk of money down on their house. That is almost unheard of in the history of home buying. And that is pulling buyers out of the woodworks. Sellers are refinancing. There is so much activity in the lending market, so much activity in the buying market just because money feels nearly free. And think about this. If you haven't bought a home yet, but you've been looking for a while, If you had your eyes on a home that last year was about $500,000 and that price has increased, we'll just round it to 10% instead of 12. A $500,000 home last year is now worth about $550,000 this year. Guess what? What you're going to pay for it really hasn't changed. That's because a year ago, interest rates were just about 1% more. 1% change in interest rate changes your buying power by 10%. So that means that interest rates at 3.5% or 4% on a $500,000 home gives you the same mortgage payment as interest rates at 2.5% or 3% on a $550,000 home. So don't be sitting out of the market. Be active. But the converse is true. If you keep waiting and interest rates go up this time next year or a little later, and home prices are going up with it, you are really losing out on your buying power. Number 3 for the market dynamic for Denver is an influx of out-of-state buyers. And I think we're seeing that in many places around the country, particularly people moving to the south. They think that warmer weather and COVID don't necessarily go together. But for Denver, we're seeing this because we have a good job market. It's very diverse here. We have aerospace, defense, tech, biotech, healthcare, oil and gas, tourism. It's very diverse. Back in the 80s, Denver was all oil and gas, and we fluctuated with oil and gas prices. That is no longer our story. And so along with the tech boom that Denver has experienced, we see a lot of people moving here to work remote. Even if companies that based here are hiring them, they're hiring them to be full-time remote. So we do have a large influx of out-of-state buyers, and many of those are coming from other high cost of living cities and experiencing a decrease in their cost of living and an improvement in what they get for home, for lifestyle. What else is impacting our inventory and these market dynamics? Number 4, seller fear. One would think that with this hot market, sellers would understand they have the opportunity to capitalize on the equity in their homes, right? Hey, everybody wants my house, I should just sell it and cash in. But they aren't. Why is that? Well, there are a couple of reasons based on research. One is concerns over COVID. Some of it is safety, but not most of it. A lot of it is financial concerns, whether it's concerns about the longevity of their job, whether they've had to take a pay cut, maybe their spouse is underemployed right now because of COVID, or just the overall economy picture long term. And then the other component of it is sellers have refinanced, they have a great rate in the house that they're in, and shopping for another house that is at least as good, if not better than theirs, is very scary in a market with tight inventory. Just because they add theirs to the mix doesn't mean they're going to find something that they really love. A lot of sellers are looking for their last home. They are wanting a ranch style home that's kind of quiet, a little bit more space in the backyard, a view, someplace that's really serene. That is a luxury property in this market almost. It's very hard to come by. So they're afraid to put their house in the market, watch it go, and have nowhere to live. Number 5, new construction. Let's talk builders. So since buyer demand is high and sellers can't meet that demand with their existing homes, builders have the opportunity to come in and fill that gap. But are they? No. In fact, permits for new construction are down, and as of the latest report, it's down 7%, which means builders won't be catching up anytime soon. And my other concern with new construction is that I feel like it might be tending toward being overpriced. That could be a whole other video, so if you are looking at new construction, we should talk. I would love to share some thoughts with you on how you can determine your new construction purchase may be overpriced or just about right. But some of the factors are that the lot premiums can get extremely high, and builders have been increasing their base price sometimes as often as every 2 weeks on their homes. Some of that has to do with their lumber costs. The cost to build a home for them has gone up about $16,000 on average just this year due to lumber. But they're increasing the base price, they're increasing their upgrades, and they've increased their lot premiums. So the cost to you as a buyer has gone up much more than $16,000 this year. Okay, at the start of the video, we talked about comparing where we are now back to the Great Recession, the financial crisis of that 2008-2012 timeframe. There are 5 fundamental areas to the housing market: home price growth, supply, demand, household income, and household debt. So how do we compare to today versus where we were as we headed into the Great Recession, that housing crisis of 2008 to 2012? Let's take a look and see if we align enough to think that we're headed for a crash in 2021. According to housing market experts Case and Schiller, in the 3 years leading up to the Great Recession, home prices increased 48%. When we look at National Association of Realtor data from 2017 to current, we see home price increases of 27%. But as you can tell, the difference between 27% and 48% is incredibly substantial. We are not on the same pace right now as we were pre-recession for home price increases. On a national scale for supply, there was more than 4 months of inventory pre-recession. Nationally, we have about 2.75 months of inventory available. So we're in a drastically different situation there as well. And as you can see by this graphic, builders were pouring new homes into the market leading up to the recession. It seems it is just so hard for them to get the balance just right. And at this point in time, I think they're going to continue to lean toward where they are now, which is not building enough. They would much rather have demand high than overbuild and be part of the problem as they know that they were back then. Let's look at the demand side of things. This chart by Statista shows you the number of home sales starting in 2005. Lending was so loose and easy then. Look how many homes were sold in 2005 leading into 2006 before the crash in 2007 and 8. Now, when you look out at the end, 2020 and 2021 are obviously projections. We have not finished this year, and we obviously don't know what next year is going to be. The last two factors are household income and household debt. We really cannot talk with strength about household income right now. We don't have great numbers. It's fluctuating so much this year with COVID, though we know that families have been hit, and it is different in each strata: low income, middle income, and upper income. But we can make some really good comparisons on the household debt piece thanks to this graph. There's some great data that has been put out by the Congressional Research Service. Debt structure has changed greatly since the last recession. Mortgage debt used to be a much higher proportion if you look at that back half of the graph. Homeowners were maxing themselves out to buy a home, putting very little down. Look at that gray line and how much narrower it is now compared to what it was back during the recession. You combine the mortgage debt and the home equity debt, and that is a huge part of what brought the market crashing down in the Great Recession. We are doing so much better as homeowners in managing our mortgage debt and home equity debt. The debt that has increased is the baby blue line, which is student loans, and the orange line, which are auto loans. That makes sense because cars have gotten 30% more expensive in the last decade alone. The dark blue line is credit card debt. Now, one might think that credit card debt would have expanded during COVID, but this chart is current up to Q2 of 2020, and it has not. With everyone quarantining, there's been less consumer spending, and while we know this pandemic has had an impact on household income, what that has not translated into is an increase in consumer debt based on the most current data. Also, for those in a fright about the forthcoming foreclosure and debt crisis, take a look at this graph. We are a people who are in much less debt, and we are current with our debts compared to where we were during the time leading up to the recession and in the recession. So I will say, I think there is trouble in the market. I'm going to touch on that in a second. But I do not think that we are flagging any of the same markers as we did heading into the recession of 2008 to 2012. I do not think we are headed for a crash in 2021. Now, what is our trouble? What's going on in the market? Well, it is harder than ever to get buyers into the home they want. With inventory being low, it makes it harder to get into a home, but you need a great agent. You need to have all your ducks lined up, your lending. You need to be ready to negotiate fiercely, be aggressive, don't be afraid, but you can still get into a home. You just may not get into the home you have been dreaming of, a home that looks like it belongs right off the last 3 minutes of an HGTV show. It may not be a new construction home that's only $650,000 here in the Denver market. It may not be a single-story ranch home on open space for $500,000. In fact, I promise it won't be. That doesn't really exist here in the Front Range. So you may have to be giving a little. You may have to sacrifice but get into a home, build equity. Just since June, the first homes that closed after we came out of shutdown, we have seen median price growth of $28,000. Get in on that, capitalize on that, have that be a part of your wealth portfolio. The two keys to growing wealth are being in the stock market and owning a home. Only half of Americans roughly are in the stock market. Well more than half own a home. Be one of them. I think demand is going to stay very tight in the coming year. I think prices are going to continue to rise in the coming year. Waiting out the market, thinking prices are going to drop and the interest rates will stay the same and work in your favor, I think is a fool's game. You are more than willing to play it. I would just encourage you not to. If you have more questions about the market, want to talk about it, even want to debate me, feel free. I would love to chat with you. It is always an honor. You can call me, text me, email me, whatever works best for you. Hey, I'll see y'all next week.